The income approach. When valuing income property, we need to focus on the future benefits that come from the property. The future benefits that we're interested in are income or simply cash flow. This method is the preferred way of valuing investment properties. Once we determine what the future benefits are, the income, the job is to put a present value on those future benefits. The value we end up with is the estimated value of the real estate. If we take a step back and look at it from a broad conceptual point of view, the income approach or capitalization approach is all about establishing the amount of money that an investor would be willing to give up today for the future income the property is expected to produce. To put this into the language of appraisal, the income approach is based primarily on the principle of anticipation. What we are anticipating is future income. An appraiser and a property owner are going to have differences in their view of an income property. The owner is typically motivated to purchase as an investment that comes with their individual proclivities in regards to risk, interest, and tax position. Each owner will also make decisions regarding financing, whether to pay all cash or more often to obtain a loan. And even in the case of bank loans, there's large variations in the percentage of down payment that the owner will want to use. The reason that this is so relevant is that the owner will consider the payments towards the loan as an expense of owning the properties and will deduct from income tax the interest paid on the loan, as well as the book depreciation from the purchase price or cost basis. It's important to note that the owner is only allowed to deduct actual expenses. This does not mean that they can include reserves for future expenses. But this is important part of a well-managed property. The owner is also going to have to compute their gross income from actual income collected or owed, not just projections. The appraiser is going to take a different tack and reconstruct the expenses and income based upon the owner being a well-informed investor without any regard for the specific individual's personal finances or tax situation. So we have to consider that the appraiser is valuing the property generally, which can lead to a divergence when considering specific potential investors. Capitalization. Capitalization converts the anticipated income into a present value for the property. There are two capitalization methods that are used in appraisal: direct capitalization and yield capitalization. For direct capitalization, such as the overall capitalization rate and GRM analysis, income generated from a single year is converted into an opinion of value. Yield capitalization considers the value of a series of income over a multi-year life of the entire investment. An income property investor is going to expect to make a return on the money they invest, and they want to recapture, meaning return the capital. And that can occur through income payments over time or the net proceeds when the property is sold. More often, though, it's a combination of the two. The characteristics of the specific property and the pattern of income will impact investor behavior, which needs to be considered by the appraiser and will cause them to choose a specific capitalization method.